What is the difference between fixed rate and adjustable rate mortgages? If you ever wondered, listen on, you're in for a surprise. So, adjustable rate mortgages. In the normal times, when the interest rates were actually normal and we weren't coming out of 2.5 years of COVID and the Fed manipulating the markets like they have been either at the beginning of COVID or now battling the inflation, I would tell you that an adjustable rate mortgage would actually make sense if you're not planning to stay in the house for more than 5 to 7 years. Today, however, everything has been flipped on its head. Surprisingly, yes. Have I seen that before? Probably not, because I try as I might think back to my 20 plus years in the biz, and no, I have not seen it. Fixed rates. First of all, what is a fixed rate? It's an interest rate on your mortgage that's guaranteed for 30 years flat, and it can change. Can your payment change? Yes, slightly, if your taxes and insurance are included in your monthly payment, because taxes change yearly in some locations. Insurance inevitably goes up. So while it may seem like your payment is changing, it's based on taxes and insurance and not because your rate changes. What's an adjustable rate mortgage? It's a rate that can fluctuate depending on periodic rate adjustments. Let's look into those a little more. So what do we normally have for adjustables? My preferred adjustable over the years has been a 5, a 7, or a 10-year fixed adjustable combination. What does that mean? It means that for either the 5, the 7, or the 10-year stretch, your rate is actually fixed at X. After that period is over, your interest rate may adjust. And adjustable rate loans with a fixed component have sometimes different adjustment periods. So we always look at what's best and what's really more beneficial to you as our customer. Sometimes it's a 6 months adjustable after the fixed period is over. Other times it's a 1-year adjustable. Would I prefer the 1 year for myself? Yes and heck yes. And would I recommend it to you? Abso-freaking-lutely. I would never recommend something to my clients that I wouldn't do myself. Have I done those adjustables for myself in the past? Absolutely. Because I wasn't planning to be in the house as long as I have, unfortunately. So typically, adjustables in normal markets, especially fixed mixed adjustables, have been coming in at lower interest rates than your fixed. So again, in a normal market, you would be looking at the fixed rate in the 6s, an adjustable fixed combination, probably in the 4s or 5s, depending on the length of the fixed period adjustment. Not the case today, unfortunately, but once the market stabilizes, will I start doing more of the adjustable fixed combinations? The answer is yes, because yes, they do make sense, especially when you're not planning to stay in the house for a long time. If you've had experience with adjustable rate mortgages, please comment below. And frankly, for the last 10 plus years, the adjustables have not been the scary beast they used to be prior to the 07-08 crash. So ask your questions, comment below, and I'll see you in the next one.